Good evening, my name is Rosalie Schultz and I'm here to present minor assignment 2 in Financial Management and Economics in Health and Aged Care. This work is about Springfield Private Hospital and Ogdenville Hospital. The first question is about Springfield Private Hospital. This hospital has an average charge per patient of $1,980 and an average cost per patient of $1,580. Therefore, the current contribution margin, the difference between average charge and average cost, is $400 per patient. The current contribution margin is the contribution margin divided by the average charge. This is $400 divided by $1,980, a total of 20.2%. The second question asks about the break-even point, which is where costs equal revenue. This can be calculated as fixed costs divided by contribution margin. The fixed costs is $260,000 divided by $400 per patient, which gives us 650 patients, providing a revenue of $260,000. Question 3 asks about a tender in which the government will pay Springfield Private Hospital a fixed fee to provide services for 400 patients. Overheads and the cost to treat each patient will remain the same. Extra cost involved will be the variable costs for staffing and labour, drugs and other consumables, and other direct costs. These costs total $622,000 for the 400 patients. These will be offset by the fees paid by the additional 400 patients of $1,980 each, a total increase in income of $792,000. This gives a total net income of $160,000 for the 400 new patients. Question 4 asks about the minimum bid that the hospital should make. This is $160,000, which will cover the increased cost of treating the 400 additional patients. Question 5 mentions a bid of $427,000, what impact this will have on profitability. The schedule I've created here shows that the current 900 patients and overheads of $260,000, we have revenue of $100,000 per year. Increasing patients by 400 to 1,300 patients with additional income of $427,000 with the same overheads of $260,000 will increase revenue by $587,000 to $687,000. My calculations are all in the Excel spreadsheet. Question 6 about other factors to take into account with a tender for 400 additional patients. An increased patient load from 900 to 1,300 patients per year is a 44% increase. There may be benefits of economies of scale. We've already seen with the capacity to tender for 400 additional patients with no increase in fixed cost overheads. In reality, this is unlikely to be complete. With more patients, there will be more wear and tear on the buildings and equipment. This will increase costs of RMR, repair, maintenance and renewal, and the rate of depreciation of non-current assets. Insurance costs are also likely to increase faster. Extra workforce will be needed to provide care for the 400 additional patients, with employment the largest cost for any healthcare institution. Any extra staff needed will be difficult to recruit as the health workforce everywhere is already stretched. A larger hospital generally reduces amenity and may lose some social capital if it increases traffic and congestion in the area. This could potentially be offset by increases in parking fees and retail revenue. There may be competition with the other services for these 400 additional patients. Part 2 of this assignment is about Ogdenville Hospital, which is selecting between machine A and machine B. Question 1 asks about the relative merits of each purchase. The calculations are in the Excel spreadsheet. If we're interested in the cumulative cash flow, we can see from my calculations, this is $26,000 for machine A and $71,000 for machine B at the end of the 5-year economic life. Neither machine has any scrap value, so machine B is $45,000 ahead in cumulative cash flow. Using the payback period method, we see that neither pay for themselves by the end of 3 years, as preferred by Ogden Hospital. After 3 years, machine A still has $4,000 negative cash flow, and machine B has $44,000 negative cash flow. The total payback period for machine A is 3.11 years, and for machine B is 3.88 years. Thus, using the payback period method, machine A is preferred as it pays for itself more quickly. However, the payback period ignores the time value of money and all income after the payback period. At the end of 5 years, the net present value, NPV, of machine A is minus $4,973, while the machine B has net present value of $30,855. So machine B is preferred investment using the net present value. Then the internal rate of return, machine A is 8.11% and machine B it's 13.34%. Thus, machine B is preferred by the internal rate of return required by the hospital to be over 12%. Question 2 asks which machine is the better investment. We can see here that it depends on the values and beliefs of the hospital. Machine B has lower outlay, a much greater cumulative cash flow. Machine B's income generation is highest in the 5th year, which is of no consequence to the payback period because the machines are already paid back during the 4th year. However, machine A has the shorter payback period. Using net present value and the related internal rate of return, they're then often preferred because they account for the time value of money and for the value of the investment throughout the entire period of usefulness. Both of these methods also lead to machine B being preferred. Question 3 asks about opportunity costs, which are the values and benefits that could have been received but were given up to make the decision we have made. Opportunity costs are the next best option. The opportunity cost is the cost of foregoing the benefit for every alternative investment. They arise because any expenditure can be made only once. Opportunity costs include financial resources, but also time and other resources that we use and cannot use again. In this example, the selection of machine B has the opportunity cost of machine A, which has the lower payback period. However, this decision was also very limited when we consider what else the hospital could have presented in, as I've shown in the diagram. Opportunity costs are important in capital investment decisions because they recognise that capital can only be invested or used once. While here we decide between machine A and machine B as capital investment decisions, we can consider these machines more broadly and include other capital items, buildings, IT, vehicles, investment in increased employment expenditure, investing in repair and maintenance, paying off debt, or investing in funds for increased future value. Opportunity costs include both explicit and implicit costs, which are the cost of using or not using resources that the hospital already owns. Not spending on these is an opportunity cost of the initial decision to choose between machine A and machine B. These capital investment decisions determine the future size and structure of the organisation through opportunities lost. Question 4 asks why cash flows rather than profit flows are used when internal rate of return, net present value and payback period, IRR, NPV and PP. Cash flows are the movement of money in and out of an entity. Profit is the amount of money left after subtracting expenses from income. Cash flows are the relevant parameter for IRR, NPV and PP because they represent the expenditure of cash, liquid assets in investments. Non-current assets and fixed costs are not considered in investment decisions or in calculations of IRR, NPV and PP. Unlike the income statement, which records revenues and expenses based on accrual accounting, the cash flow statement focuses on actual cash inflows and outflows, helping stakeholders assess the company's ability to sustain operations, invest in growth and manage operations. Thus, cash flows are the relevant measure when calculating parameters of IRR, NPV and PP. Thank you for your attention. I hope you enjoyed watching this assignment video.